Hi, everyone, and welcome back to Markets in 2 Minutes. This is Connor Darrell from the WealthSpire investment team. There's been a flurry of activity down in Washington since the new administration took office about a month ago, but all the different executive orders and policy ideas that have been thrown around in the early going, none of them grab the market's attention and interest quite as much as the discussions around tariffs have. So, for this month's discussion, we wanted to do a quick dive into how investors should be thinking about tariffs as it relates to market and economic impacts. There are a lot of potential economic implications when it comes to tariff policies, and those are listed across the top of this table. But it's important to remember that none of this is happening in a vacuum. There are a whole host of policy initiatives that are being discussed, but one that is likely very high on the administration's list is a second round of tax cuts. And when you think through the cause and effect, in many cases, those tax cuts are likely to counteract some of the impacts of the tariff policies. To start off, to the extent that tariffs put stress on aggregate demand and slow economic growth, tax cuts would have the opposite effect. Additionally, there's also a potentially balanced impact on the budget deficit because the increased revenue from tariffs is likely to be offset by the decreased revenue following a lowering of tax rates. For equity markets, tariffs represent new costs for businesses that could hurt margins and reduce earnings, but tax cuts would have the opposite effect, and in many cases could even completely drown out the impacts from tariffs. The one area, though, where the two policies are likely to have similar impacts is with regard to inflationary pressures. There's a pretty clear cause and effect between tariffs and prices, right? Anytime you impose additional taxes on goods, it drives up prices, which are then going to be, at least in part, passed on to consumers, and that puts pressure on inflation. But tax cuts would have a potentially similar impact to the extent that they bolster demand and business investment. And that's what we've seen markets most definitively respond to. We track tips markets pretty closely because they offer a good sense of how the market is pricing in inflation. And what you're looking at here is the break-even inflation rate for a 2-year investment horizon. This is essentially the market's expectation for the rate of inflation over that time period. So in this case, the next 2 years. And you can see that tips markets have been pricing in increasingly higher levels of inflation for much of the last 6 months as markets started to prepare for a potential second Trump term. Likely because the market understands that these two key policy initiatives, tax cuts and tariffs, are likely to both have the same influence on the inflation rate. From our perspective, we think this is something that happens more on the margins rather than seeing another major spike like we did as we emerged from the pandemic, but it does likely signal that the Fed will be less likely to cut rates as we move deeper into 2025. But to take a quick step back here, the takeaway that we wanted to leave you all with is that there are some complementary elements to the Trump policy agenda that should serve to keep the market and economic impact somewhat muted. Inflation is something that the market and Fed will be keeping a close eye on for sure, but for now we need to see how the rest of the policy agenda plays out. We'll be back with further updates as they take place. Thanks for listening.